Cool, man.
I think we're live. Welcome, everybody. Appreciate you joining us on this Wednesday afternoon during your busy schedules. I'm Ryan Paliukaitis with the REIunite show, and we have Mario Camino as our special guest of Arkad Capital. And today we're going to dive into basically raising capital for your deals. Everyone's always looking for money and looking for funding for particular projects. So we figured, you know what, let's go ahead, let's take a deep dive. We're going to cover some basic stuff because some of our listeners are very new. And we're also going to cover some of the more advanced stuff for those that are seasoned investors. So if you are new, don't worry, it's not too complicated. You won't get intimidated. And if you're seasoned, don't hop off for some of the basic stuff. We got you covered as well. So appreciate you being on, Mario. It's been a minute since you've been on. If you recall, the last time you were on, we had you discussing the ADA levels with expansion developments. So
Right.
things have changed a little bit. I mean, why don't we use that as a segue? How did you, get into this space of the money?
Yeah. So it's look, it's not just because it's mine. I believe it's a true wonderful real estate story, right? We started with the bricks and mortar, and we're still in it. That scaled up as time went on, like you mentioned. We became very savvy at adding levels and doing ground up new construction, luxury ground up new construction specifically, and that all that created let's call it for what it is, created more opportunity, and that sort of opened new windows, new doors, so to speak, to higher grounds. And look, the financing side of real estate, of real estate investing, has been something that we've been talking about it for years. We just never really really came to a place where we, frankly, with financially and structurally, we could. So that happened about almost 4 years ago, and we were able to create Arkad Capital. We came together and created really a company that was a little bit outside of the standard, I guess, hard money or known hard money type of company. We wanted to lend money, and we wanted to lend money safely, but we wanted to improve a few things that had been just going on as almost like a standard for so long, from high rates, high points, crazy fees in between, the terms of the loans. I mean, there's all kinds of issues, prepayment penalties, full boat payments. So we really wanted to come in and sort of cater to the investor, create something that was that was good enough for us, right? Like something that we could use, because until then, it was sort of all over the place. There were only a few lenders in the industry, and they really called the shots, right? There was very little room to negotiate, if you may. So anyhow, so we found an opportunity. We believe we saw a gap really in the market, and decided to go for it, and decided to launch our own Harmon Lending Company with a twist, right? Because look, for all intents and purposes, we're not lenders. We're not. We never were. We learned the industry, but we've always been real estate guys, and we still are. We still buy, we still fix, we still sell, we still build. So being able to really bring that world into this, and really create products that cater to people like us, it was pretty powerful from a performance standpoint. It really propelled us, and it really allowed us to grow very quickly, right? A lot of people took note to a lot of these products working well. But and since we're on the topic of leverage, a lot of people also took note to the structures that by then, for years, we had been putting together to be able to finance these deals. So not only that we were able to give people capital to do their investments, buy the properties, fix them from residential to commercial, but we were able to bring the knowledge of the structure on how to actually put these deals together, how to raise the private equity, private capital that you need to put the deal together, ultimately as far as how to split the money, and of course the construction piece of it also. So we were able to plug that hole, I guess the unknowns that most harmony lenders are not really going to tell you. They're not really they're not really in the business of putting that out. And the main reason is because and we'll get into the specifics of leverage. The higher leverage you have, the more the higher the inherent risk is. So you raising capital, private, leveraging against hard, having 100% finance deal, although it's from a real estate investor side, it's mecca, right? It's the best position to be in. From the lender's side is a little bit it's a little bit different. It's quite the opposite. So being able to balance those two well is very important. So anyways, we'll get into that. So look, I just kind of went rambling on. Thank you again for the opportunity, man. We live in Planet Zoom now, and yeah, I hope a lot of people get a lot of value from this.
No, I appreciate you being on. Like I said, for a while, it's always good. You always come with a lot of knowledge, experience. Before we lose some of our, newer listeners or whatnot, and I won't spend too much time on this, but there's a little bit of jargon that they may start rolling their eyes and saying, what is that? We mentioned private money, hard money. Why don't you just give them a quick rundown, the difference between the two?
Right. So let me start with hard money. Hard money, even when we started in the business about 15 years ago, fresh out of Rutgers, by the way, is my is when I started serving to this beautiful industry. Um, when we started, hard money had sort of a weird name, right? And in many ways, it still does. That the notion that it's hard really confused people for years and years. Now we're in the era of technology, so information travels a little bit differently. Borrowers as buyers are far more educated than they ever were. So they're starting to understand that the term hard really comes from the hard asset attached to that loan. In this particular case, the the multifamily, the commercial property. The asset itself is the hard part of this. The process, it's frankly quite soft. It's easy. It's streamlined. It's systemized. It's redundant. And it works. And it works for a lot of investors. It gives them that hands-off financial security that they need when putting a deal together, that we all need, right? We want to know that we're going to have funding at the closing table. Um, so um, the the private money, I guess, side of things, it really, I mean, it spreads across multiple ways of structuring this, but for all intents and purposes, private money is generally money that may still be attached to an asset or may not. It might be collateralized or not, but it's usually money that comes from less structured sources. Example, family, friends, and so on. Whereas we treat this very much like any other mortgage, and it goes into sequences. Private money is a lot easier, a lot not easier. It's a lot simpler. It's a lot looser, because generally speaking, the people that are lending you that money don't have the lending education to really look at a loan and measure its risk. Now, that being said, I'm not saying people just lend to lend. There are many people on the private side, that including people that we know, that are very savvy on this and understand their position first, second. They understand the risk they take, and they're quite happy with it, right? So anyway, so that's kind of the difference. Private money is easier money to attain, to spend, less oversight, so to speak. Uh, Hard money, people in my industry really bring a sense of sort of order to the entire process, which frankly, especially with newbies, when someone just starting out, that sense of having someone, that sense of oversight, that sense of having someone sort of making sure that the deal's going well because their money is in it, but also because you're a client, sort of helps people really learn the process thoroughly, not just buy a house with somebody that just wired you money, but understand construction, understand the process of construction, understand the process of closing, understand the legalities of taking that money, regardless of who it's coming from. So anyway, so those are the, I guess, the bigger differences.
Typically break it down, and if it's saying like, your hard money or people or businesses or companies that pretty much do this as their business or core business or one of them, versus your private money may be, like you said, a friend, an uncle, family member that has some extra funds. They, see that you have a good business that's going to give them a safe, secure return on investment, and they're tired of getting that 0.5% at the bank. So you give them a opportunity where you're using real estate as the vehicle to give them a better return on your money. And so in essence, that's pretty much the difference on a basic form. So now that we kind of addressed that, how does these new investors, how do they go ahead and use this private money or hard money for real estate?
Yeah. So there's multiple ways, but um basically in its simplest form, the idea is for you to be able to raise. Look, there's multiple ways to do this, right? But let's talk about why doing this in the first place. So let's just make sure that the audience understands the benefits of leverage. I think it's fair to really dive into the whys, right? I mean, and first and foremost, I think it's important to know that, and this is sort of where I step into both worlds. The less money you have into a deal, regardless of what your profit is, the higher that return is going to be, right? You the less skin you have into a deal, um, the more profitable you're going to be. So, and needless to say, the less risk you're going to take because you have no capital into the deal. Now, I think um, this works well when you're starting up, and I mean it works well if you have a larger operation as well. But I think this works very well when you're starting up. Um, and the way really to do it, man, is to secure the person that's giving you capital. Um, Generally speaking, and within the LLC, so in a partnership type of format, where they may or may not um, sign personally a personal guarantee for the rest of the money. So in other words, let's say you're buying a house for $100,000. Let's say because you're just starting up, you have to put 20% down on that purchase, right? So you're gonna raise that $20,000. Um, the There's multiple ways to do it. I guess the simplest way is this, just take the money and put it in your account and use it as a deposit. But in reality, you really want to treat this money properly from the get go. So the best way to put it together is the person that's giving you the 20% should really be part of your partnership, should really be coming into your LLC or your whatever entity you're using, and that person should have a minority stake on that entity. That will secure their position as an owner, a minority owner, but it'll secure their position enough for them to feel a degree of comfort by giving you that money. And the reason you want to do this is because, generally speaking, the first position lender, in this case us or any hard money lender that's giving you the other 80%, in this example, the $80,000, that lender is not going to want a second position lender, as another lien, a second or third or fourth for that matter, lender in the chain of title. In fact, it's going to be spelled on your documents, right? So we're telling you from the beginning, don't add more lenders to this. Don't take more liens on top. But we're not telling you you were not allowed to have a partner. You can have a partner anytime. I mean, there are some steps that have to be taken. The partner does have to be vetted. There's a lot of fraudulent stuff out there. There's money laundering. There's all kinds of things. So we do want to know who the partner is. It's not like it's this like dubious person that nobody knows. And we want to know who the person is. We're gonna, although we're not gonna make a decision or a determination based on their credit. We do what we, and frankly, we don't really care about the credit, but we care about the background. We care about who the person is and what they're involved in and any previous issues they might have had. Assuming that's clear, you and assuming that particular person has access to capital, you just found yourself a good partner, right? And now every single time you purchase a property, this person is going to have a minority stake in that LLC. but you're not going to have to be worried about, recording mortgages or doing anything like that. And the person will be secure. So in other words, you can't sell the house without that person also signing on the dotted line. The investor goes in your operating agreement, and they're really just part of the process. The real question in that structure is whether the investor um, wants to be liable, personally liable for the first loan, the 80% loan, whether you get it from a bank, Harmony lender, whomever it is. Um, Um, yeah, we got a question, Jess. Yeah, I mean, they have to have these. If it's a terrible credit, our threshold is usually 650. In situations like these, we'll look at a 620 or under 600 FICO, given the fact that they are non-grantor. So I guess what I was saying is, what you really want to determine, and this is you as a businessman, as a real estate investor, you determine the type of relationship you have with your private lenders. So you offering something like a non-recourse position might be advantageous when you're negotiating the terms for your partnership. I'm going to repeat that. So, as a real estate investor, and us, so what you're getting right now is a little bit of underwriting uh, math from our end, combined with you raising capital as a real estate investor on your end. And this is coming from, I mean, we learned this back when we were, when we were raising capital, we were flipping houses because we were borrowing money from hard money lenders. So we had to learn to structure this properly. And this is how you do it. So um, the I guess let me get into the pieces, the components of what you should be raising before we get into anything else. First of all, you're always going to need down payment money. If you're trying to leverage your money, I mean, if you're trying to leverage money against a hard money lender for in this particular example, the 20%, you're always going to account for that. Eventually, as you do 3+ more deals, that 20% becomes 10% down, and the money that you got to raise from your investor becomes less and less. But you're always going to think of that percentage. You're 20% down. You're going to think of your closing cost, and if you want to be safe, do at least 6 months of debt service added to that loan. Once all those, I guess, basic components are in place, you wanna measure your I guess your structure, your liability with this investor. So as a lender, we're perfectly okay with anyone, or in this case, a lender, having a 15% or less stake in the LLC, ownership in the LLC. If they have 15% or less, our banks is usually 20, we do 15. We really don't need that person to be a personal guarantor on the loan as you're going to be. In other words, that the person will be not liable if anything goes wrong. You would be. So what this tells an investor is, okay, so I have the security for on the LLC. I'm a part owner of that. So, this JV, this partner, this real estate investor, he can't just run away and sell the house, right? Like, he needs me. And number two, it also tells the investor that you're really taking all the heat for this, right? Like, you're raising money for them, but if this goes wrong, the only exposure that they're really going to have is the money that they put into this, nothing else. And when you're negotiating terms, that's a huge part, and a lot of us forget about that, and a lot of us kind of just look the other way and throw money into accounts and think it's fine. Well, if it works for you, and if money's coming from your dad or your uncle or something along those lines, then I guess it's fine. But truth of the matter is, not many of us out there have those type of opportunities. So being able to handle that process properly is super important for repeat business. So that's one way to do it. Now, if, let's say, the investor wants to give you crazy terms, I know a lot of people out there do like a 50-50 split, whatever those terms are, and you may want to consider asking the investor to be on the loan with you, right? Maybe they have excellent credit. Maybe you're doing a commercial deal and their balance sheets are huge. I mean, who knows what the case may be. But you really want to use that to your advantage as you're negotiating terms. Terms more than anything, time, right? Time is your biggest friend and your worst enemy in real estate. So yeah, if you know if it makes a difference between having a term of 12 between 18 months because this is a big at a level, then yeah, you may not want them to be liable on this, right? You may want to use that as a carrot, I guess, so to speak, and not put it on the table. You know, keep them off the table, keep their liability off the table. So anyway, that's how you sort of how you marry these two worlds, man. It's one way to do it. I mean, there's a few, but this is the better way to do it.
Yeah, no, I appreciate that. Because a lot of times the people think, hard money, private money, they may just assume, okay, it's going to be a note mortgage filed, et cetera. But I appreciate you going down, explaining more of a complex structure with bringing them on as partners and LLCs and whatnot. Because, I mean, at the end of the day, there's really almost endless ways which you could structure this. So with that being said, someone may ask, what are the benefits of, someone using other people's money?
Mm-hmm. OPM, right? Um, yeah, I mean, look, the benefit is really one of ROI, right? It's the return that you make. If you have $20,000 into a deal and you make $20,000, that return is far different than if you have zero money into a deal and you make those $20,000. Technically speaking, the return is infinite if you have no money into the deal, right? So, that's number one, right? That's kind of like the obvious one. Number two, and I think more importantly, is really your ability to scale, right? I mean, I can tell you for us, as Arkad, that was really the change in point, right? That's when this ship started heading in a different direction. Is when we truly focused heavily on raising capital and raising it properly. So I think for an investor on both ends, right? On the front end, if you're just starting up, being able to do more than one deal and keep risk for your private lender, spread risk for your private lender. So let me touch on that actually. Look, I talk to a lot of people, right? And I talk to a lot of cash buyers. We have a lot of builders in New Jersey that like for years just do cash deals. They buy the land cash, buy the whole house cash. We have a lot of people that also, come into this and they already raised the money, right? Like they talk to their family members and they're ready to go and they have 200. I mean, I spoke with a guy the other day. He had about $200,000 ready to start buying. And his plan was like, look, I'm gonna buy for 150. I'm gonna do 50,000 or like 30,000. I'll do the other 20 in closing cost, and that's it, done. Easy. And I like to be real with clients. It's what I just call it one of my superpowers, right? Is the ability to talk from experience rather than theoretically, and the reality is different, right? The reality is this is New Jersey, and finding a deal that small is not really that possible. But the truth behind you coming in with, let's say in this example, $200,000 and putting most, if not all, that money into one deal, it's absurd. And you may think that it's the right way to do it because this is just your family's money and you don't want to mix it and you have all kinds of feelings and thoughts about it. But from a risk standpoint, from a financing standpoint, it's frankly one of the worst things you can do, especially if you don't have experience, right? You're coming in to gamble really with full leverage, nothing from you with somebody else's money on something that you may or may not be an expert on. So I always recommend what we do and what we did. And this was literally, this happened about 8-9 years ago. At one point we were doing a lot of private money and we decided to take all of our investors and all of the private money specifically. This is not the hard money side, the private money, and talk to them about taking their money, and rather than doing one-offs, because at that point we have a bunch, we're doing 5-6 deals all with individual investors. Instead of doing one-offs, that we split their money into what we still call, now today we call them purses. A purse is exactly what it sounds like. It's a purse of money. It's to us that based on our business model, it's a $70,000 to $90,000 purse. So every time we do a deal, and this is single family to multifamily, usually flip. I mean, on this pipeline, we don't hold these are rehabs that we resell. Um, on the, on those, we generally speaking, we have a $70,000 purse. The purse covers our closing costs, it covers our down payment, it covers our debt service for 6 months. It also gives us startup capital for the project, usually about 5% of the overall project, so not a whole lot. But then there's ways to structure your SOWs, your budgets for them to flow nicer with you. Another that's for, I guess, for another topic. But um, point of the matter is, you're able to to come together with all this, man, and sort of make it, I guess, make it all work.
Yeah.
1 second, let me blow that. I'm coming. I'm at the tail end of a cold, man.
At least it's not COVID-19.
No, it's I was very lucky, man. I got the vaccine. I got a yeah,
Okay.
yeah. So I'm safe from
All right.
that, thank God. Um,
So
but yeah. So a purse is super important, man, and I hope people that are listening out there take the concept and utilize it, because by you splitting, and let's say in an example, your investor has $250,000. Let's say $200,000. But by splitting those $200,000 into small purses based on your model, let's say, I don't know, 50,000, right? Um, you're spreading that risk over 4 different houses. You're taking 50,000, you're doing one house. You're taking 50,000, you're doing another house. You're taking another 50,000, you're doing another house, and so on. If one of those four goes belly up or does not bring you a return, the other three may. And more importantly, your investor's capital was not all placed into one pot. It was spread over 4 different houses, and therefore it was technically 75% safer than it would have been had you put it in just the one property. So starting up, I think that's an important thing to tell an investor, right? Like, I think this is something that makes perfect sense, and when you explain it to an investor, you're truly showing them that you're aware of what's happening, and you care about their capital, and you don't want to lose their money, and that this is truly a better and safer way of spreading your money around, or their money around for that matter.
right.
And yeah, so it's important when you're starting up. It really changed our way of doing business. Our investor said, yeah, I mean, that sounds fine. And that took us from, having a pipeline of 5 houses at a time to having a pipeline of 20 houses at a time. That was truly the major leap. And of course, operations come along with that, right? As we grew, we needed more construction people, we needed more resources, we needed more management, we needed construction management, and so that's kind of the evolution to this. To me, the real leap was that the ability to fully understand those two worlds, bring them together, and really just being redundant about it in many ways, and it's still the way we do it, by the way. I mean, this is literally the way we still do it. So nothing has changed.
Gotcha. So, I mean, you kind of delved in there a little bit as far as like, okay, if, we can go ahead and diversify the funds through a portfolio to go ahead and spread out our risk and whatnot. But what if we were going to switch gears a little bit? Let's say the person who maybe only has one deal going on, maybe they have their mom or brother or whatever, that's willing to lend a portion. Maybe, here in New Jersey, prices are a little higher than other parts of the country. So they have that gap. Maybe they have enough just for the down payment, or, a portion of the rehab, whatever. How do we go ahead and bring the hard money, private money in a deal like that so that, as you say, we get the best of both worlds?
Yeah, I mean, look, if you're starting up, you really want to focus on the basics, right? If you're raising money, that is, like, if you have access to money, regardless of who's lending you that money, focus on your deposit, right? You're gonna need that money pretty much across the board. Uh, that being said, look, for repeat clients and experienced clients, we have programs that basically cover those deposits, right? So there is a at one point we become your private lender. We gap all those gaps. We fill all those gaps. But starting off, if you're really, if you've never done a deal, or perhaps you did one, you're going to your second, or truly this is your starting point. Um, Couple of things, right? You want to focus on your basics. You need money for a deposit. You need money for so your down payment. You need money for debt service. I think the best case scenario is 6 months. That gives you 6 months of payments, sort of already embedded in the deal, embedded in the loan, so you don't have to worry about that. And also closing costs, right? You're gonna need closing costs. That doesn't matter where you go, doesn't matter what type of transaction you're doing, you're gonna pay for those fees for that transaction happening. Um, so you're gonna need that, and that generally speaking is, depending on the size of the deal, we're talking five to seven to $10,000. Um, and Me personally, I mean, I know some people do it differently. Me personally, we always like to have a portion of the overall budget, an initial release, so to speak, of construction dollars from the beginning. That's usually, depending on the size of the deal, 5 to 10% of the budget. So we take all those numbers, we put them together, and we say, okay, well, this deal, this is the purchase, this is the rental, this is more or less how much we're gonna need, right? It's not always an exact figure, but at the very least, you've covered all your basics. From then on, so that's step one. Assuming that you're able to raise that capital, of course, the legalities of it, right? And make sure they're in the operating agreement. Make sure you open up an LLC with them in it. Um, Make sure you have a partnership agreement signed. Once you get past all that, go talk to a lender. Go talk to a hard money lender, somebody that can leverage up the rest of the 80% that you're gonna need, the 90% that you're gonna need. Get qualified, get approved. That's another thing, man. A lot of people, I mean, I'm giving you the basic process. In many ways, I believe people should get approved before they start raising private money. And I've done this with a couple of, not a couple of, bunch of clients where they're just starting up and they want to know how this works, and they get approved by us. Their credit is good. They have no experience. We know it, but their credit is good, right? So they get approved for a program with for somebody who has no experience. So then they take that approval and they show it to their investors, and they literally go, and look, we suggested it to a couple. Not many took action, but some that did are still working with private investors. They took these POFs, these approvals, to their investors and said, look, I'm approved up to 80% of the cost of the project with this investor, with this lender. Look them up, research them. They're all over the internet. They're all over. You'll find them. Check them out. And assuming you're comfortable with it, I would be raising the remainder of the needed capital from you, including the 20% for the deposit, so I can have the entire loan, including the closing clause, including 6 months debt service, and including 5% of the startup cost. But the most of the money is already approved. And that gives an investor confidence that you know what the hell you're doing, right? Like that you've already taken the steps necessary to really treat this like a business and really push forward, especially if you're starting out, right? To me, that's sort of like the dividing line between like talking and doing. A lot of people like want to get in, a lot of people want to invest. But I think the minute, kind of like buying a house, right? Like a regular house, like normal houses, normal people. You don't know what the hell you're buying or where you're buying until you get pre-qualified by a loan officer, right? So it's kind of like the same thing. Like, how are you a real estate investor or trying to become a real estate investor if you haven't even been qualified by a lender, by a reputable lender, somebody that's telling you, because of who you are and because of what you've done in life and your background and your credit and your experience or not, this is how much money we're willing to put forward or technically, behind you. So all you really need to worry about is the difference. And I don't know, to me, there's doing business and then there's doing business well, right? Like if you're doing business well, you really want to think of these things. And just so we're clear, dude, like Man, business is good, and I love new clients, but this has nothing to do with like having people getting approved by us before they raise money. In fact, I was kind of going the opposite way with this. But truth of the matter is I suggest this to our clients. I suggest this to people I talk to when they're like, just coming into the game. They don't know which direction to go. They do have access to capital. They haven't finalized that yet. It's like their uncle told them, hey, if you find a house, like I got 100 grand for it. So just stuff like that. Like there's you being able to bring forth a plan is important in any business, especially when it's real estate, right? We have investors that when they raise capital from their friends and family, not only that they and granted they know their family have they have money or access to capital, they always have an appraisal, they always have a scope of work, and they always have our approval for that deal in hand. And they take those three items and they go, this is the deal, these are the numbers, this is how much they need. I believe they have a calculator too that they put together, like a simple breakdown of the profits for their investors and all. And they pay, I believe they pay a pref of 7%, no, 8% pref on their money, and they give them 20% of the equity of the profits at the end. And that's it. And it works over and over and over and over. And it's proper, right? Like it's clean, it's good business.
Right. No, I appreciate you diving into that a little bit. I mean, it was a perfect segue to, dive in and say, hey, how do you structure these deals properly? And, at the end of the day, if you position yourself as a professional, you'll go ahead, you'll get better responses. You'll be treated as such versus somebody who's just kind of shooting from the hip or, coming across as a novice. So before we dive into the programs that you have available, I know you have ones for flipping and even long-term for rentals and stuff like that. I think it'd be good to maybe just dive a little bit into maybe the do's and don'ts of like, those that are, coming for funding and things that you shouldn't do that maybe newbies are doing, or people that maybe aren't even seasoned that, maybe could complicate the process versus things that you should do, as you mentioned before, hey, getting qualified up front, doing the due diligence, doing what's required so that, you're taken serious in the game. So maybe, you probably see it all.
Oh, yeah.
With various lenders, some have certain requirements, other ones a lot less strict. I mean, but at the end of the day, I'm sure there's some helpful pointers that you could say, hey, look, this is what you don't want to do, and here's some things that you definitely want to do. And
Yeah.
along those lines.
Yeah, look, I know there's a lot of there's so many things. Let's just touch on a few, but I know there's a lot of misconceived notions of 100% financing. And we just spoke about how to do basically the best way to structure 100% financing. We literally just went over it, but the notion that you can call a lender and expect 100% financing is not realistic. And I think the more you educate yourself on how the entire process works and who the players are and how they come into each and every piece of this, the better off you're going to be, right? So you meet a lender right off the bat. The last thing you really want to do is reach for things that are not, frankly, within your bracket, so to speak. I mean, it's like asking to let you drive a Ferrari when you've never driven a moped. So it's not just because we don't want to give it to you, it's because we literally know you can get hurt with it. So there's money management skills that are needed in order to run a budget. Even a $30,000 budget has line items. So and just so we're clear, about somewhere in the ballpark of about 82% of all single family flips, residential flips, go belly up because of the construction piece. So we take a lot of emphasis on working with you on your scope of work. My partner Dan, he literally goes through every single scope of work for every single build out, rehab, conversion, everything that we do and land on. Dan does exactly what he does for Arkad. He looks at construction numbers inside and out, and generally speaking, has a conversation with the borrower about how good or bad or great or what needs to be added, changed. For the most part, there's usually savings. There's usually things that we could help with, resources we can give, and so on. So I mean, it's first and foremost, man. know where you fit, right? Like if you just started this, don't expect to get 100% financing from one lender. Learn how to structure it from multiple lenders if that's the route you want to go. Look, the next one is quite obvious, and I'm, I hope it resonates with some, and I see it often, and sometimes I'm just like, I wish I hadn't, because it's almost like obvious, right? But your credit. Um, Look, we're coming into a world where information is so readily accessible. Credit background, so much information is out there. And in industries and companies like mine, we pay for services that allow us to have access to all this data. Um, if you're coming into this business and your credit is terrible or not up to par, first of all, know what the credit requirements are, right? Like 650 is gonna put you in a decent place. Anything under 600 is probably not gonna, you're probably not gonna like it. You can probably still get financing for it. I mean, we have a couple that we've done, a few where they pay you, more than likely you have to pay for 6 to 9 months in advance because you're not credit worthy, right? It's like a credit card that doesn't trust you. So so you really wanna take care of your credit. And just so we're clear, dude, this is not changing. Like, I know there were times like 10, 15 years ago when some of these lenders didn't look at your credit. I know there's some now that don't even look at appraisal. Look, all that is like, all that is changing. Credit is becoming a major standard. Credit and experience is becoming a major standard on how the secondary market for these loans even works. So it's not a matter of whether I'm going to be willing to overlook you because you're a cool dude. It doesn't work like that. And it stopped working like that a while ago. And there still are people out there that haven't thought about this and caught up with this and still, forget to pay and it's not even like a lot of debt. Like I knew people that missed a $20 payment. Mm-hmm. Oh no, like just little stuff. And it makes such a difference. So for example, if you it makes a difference across the board, right? So like if you have no experience, none, and you want to do a flip and you have over a 700 FICO, we can actually lend you all the way up to 85. So instead of putting 20% down, you're only putting 15% down. So your good credit literally saved you 5% starting up, like right off the bat. Whereas everybody else have to put had to put 20% down. If you're doing a rental loan, which no experience needed, but let's say you wanna refinance something, right? The difference between a 700 and plus minus is a difference on the LTV. When you refinance, and we can refinance you all the way up to 75%, if your credit is over 720. Whereas the other way, I'm sorry, 80% if your credit's over 720, but if it's under 700, you're not making it past 70%. So that's a 10% difference, right? If the value of your property refinance is 400,000, that's $40,000 difference that you're not cashing out on or capitalizing on, because you forgot to pay your friggin' credit one bank card last month. So it makes a difference, and I don't mean to I hope no one out there takes it the wrong way, because I know life happens. Like, I know things could happen and you couldn't make your payment, and I've nothing but love for people out there that are struggling and need to make it through, and especially if they have families. But like in any other good business, you really wanna look in the mirror, right? And you really wanna, if you're serious about getting into real estate, get serious about your credit. And it's across the board. It's not just with me. I'm not a bank or yet, right? But it goes all the way up as you scale up, as you start dealing with credit unions, perhaps the regional banks, perhaps project is big enough to deal with one of the bigger banks. They're always going to look at your credit. They're always going to see who the hell you are and what you've done, and also your background, right? Like, again, life happens, right? But if you, for example, like I had a guy, I'll give you two examples that are going to resonate with a lot of people out there. I have a guy who got caught with a large amount of marijuana about 25 years ago, and he went to prison for it. And he went to prison for a while. He was in prison for about 10 years. Great guy. super cool dude. I didn't think that was the case, but he was upfront with me. He was like, look, this is the case. So because this happened so long ago, yeah, we know it happened. But it doesn't, it makes no difference to us. It happened a while ago, and we all got past all that, including himself. And now he's a very successful real estate developer. Um, we have examples where I had a guy, I mean, pristine guy, excellent credit, actually went to a very good university. He had a good job. He was a consultant. He was making good money. And I guess on a stupid Friday night in Philly, he went out, got in a fight with some dude that said something to his girlfriend or something along those lines. He hit him. Somebody hit someone with a bottle. Point is, the other guy ends up in the hospital, and this guy gets charged and arrested with aggravated assault. Eventually, I believe he got some type of it wasn't his first time, but I believe he got some type of time. Not a whole lot, but he did some community service and so on. But the arrest record came up, and it's one of the issues that we have, and it's one of the things that, again, the secondary market determines a lot of this. A lot of us, in fact, 99% of this business really now is all kicking up to the secondary market. We're all selling our loans. It's really becoming the new standard of the industry, and anyone that says otherwise is frankly full of it. But point of the matter is, even those that may want to portfolio something, especially if they're going to hold on to paper, they really want to know who the hell you are and what the hell you've done. So I guess the last example, man, is just one of many that could be preventable, right? Like you could take a different path, and if you're serious about getting into real estate, A, take care of your credit. B, take care of yourself. Right? Like be careful out there. Don't get arrested. Don't get caught with like a drug arrest for something serious is a big problem. And so yeah, that's it for the most part. There's so many other things, man, but I think those are some of the basics.
Okay. No, cool. I appreciate it. So I don't know what your timeline's like, but I obviously want you to be able to tell a little bit about the programs you have to offer, and hopefully we could dive in, maybe a little Q&A. I know a question popped up that you answered right in the beginning there, but yeah, if you want to just kind of go into a little bit of the programs that you're offering, and then for anybody that's live with us here, if you want to go ahead and type in your questions in the chat box, we get them answered, and we can wrap it up.
Yeah. So I'm pretty sure Joel is going to share a link with with everything we have. And what we really did here, man, is we created something that will cater to investors of really all sizes, right? We wanted to cater to the little guy, the entry level guy, or gal, because we do have a handful of really ass kicking gals that same scenarios, started with little to no experience, and now they're on deals 7, 8, 9. So we created something that really allows for the entry level investor to come into this business safely, in a consistent format, affordably too, not to mention, as well as products that cater to the bigger guys, right? Like the out of level guys, the ground up guys and gals, all the way to the people that in many ways like us, man. A lot of what I'm telling you is sort of like the trajectory we had, and we knew that if we just had products along the way for people to be able to take advantage of and really scale and grow their businesses, we'll be in a good place. So we have products that cater to the bigger guys, right? Like if you have a bunch of smaller multifamily, you want to buy bigger commercial property, mixed use, residential, retail, we have it. And before we only had the sort of the commercial fix and flip product. Now we just actually launched the long-term commercial fix and flip, well, commercial long-term rental. So not only that we can help you buy a building, but now we can help you refinance it on a 30-year fixed loan. So the idea here, man, is to really build people up. From the beginning of the company, we wanted to bring that forward. Something that when you came into, you really felt progress. You felt succession. You felt that you have the ability to, do these smaller houses, but when the opportunity arises, you can also build a house. You can also perhaps add a level to a house, right? Perhaps you're tired of all that because you've done it all. Now it's time to really create some cash flow for yourself. So we start with a very basic. We have a basic bridge product that allows, frankly, anyone with a FICO score of 650 or higher to be able to purchase something with roughly 20, for the most part, 20% down. 20% down on whatever you buy. If it has a construction component, we usually finance that 100%. And the LTV for those is usually capped out at 65 of the future value. So 65% is your all-in of whatever that future value is. Here's a cool little equation for your audience. I mean, for whomever is listening, I hope they use it in the field. Take your purchase price, and this is how I look at deals as a lender and now as a buyer as well. But take your purchase price times your whatever your the leverage you're gonna get is, right. So if you're just starting up, 20% down, multiply the purchase price times 80%. So 100 minus 20, multiply it times 80%. Add your construction costs. That's your loan amount. Divide that by the ARV. That's your loan to value ratio. If it's over 65, you can't do the deal. If it's under, you got the deal. So if you're starting up, just remember this formula. So when you're in the field, you can just easily know if we would fund the deal, because literally I'm gonna look at it the same way I just described it. There's a whole lot more, but at first glance, that's the way I would have looked at it. So if you're, I guess that kind of answered the question, right?
Yeah, no, that's good. I mean, we'll post that info as well. That's good, just so that someone could just do a quick down and dirty to say, okay, we in the ballpark here. Oh, this is never going to fly, or okay, we're in the green. Let's go ahead and dive deeper in, get the numbers, get it submitted to Arkad, etc. Awesome. Well, I appreciate that. We have Luis Muniz chimed in. He said, the Zoom created amazing content for me. As you're aware, I'm the new guy and I've raised private capital. Knowing how to leverage and not give up is super important. Thank you. So I appreciate the contribution.
I believe Luis, I mean, he's a new client of ours. I believe he's actually using what I mentioned before when I said get approved and then take your approval and raise capital with it. He's doing that. He's literally doing that. He got his credit high up to our standard. Actually got higher than that. Got approved, and yeah, he's on his way, man. So yeah, he's a prime example of this stuff.
Very cool. Now, so you're lending, I guess, primarily in Jersey or other states as well?
Yeah, we're nationwide. Primarily, though, our focus is really the tri-state with a lot of a big emphasis on New Jersey. I think the other product that we should talk about, man, is the rental product, because that stuff is hot right now. There are a lot of landlords being made. There are a lot of house flippers and wholesalers who are now crossing over to the landlord inside. So to me, that's a transfer of wealth, right? That's something that I want to be part of, because it's just, historically, this is one of those occasions where you can of course participate and be part of that transfer of wealth, but B, you can finance that transfer of wealth. And that's quite a great position to be in. So this, again, the secondary market, right? Wall Street basically stepped in, and before Wall Street stepped in on the fix and flip side, Wall Street stepped in on this rental side. A lot of big players bought a lot of single family houses, and a lot of that equity went up, and a lot of that rent went up, and those players almost validated that this is the small idea of being a landlord, mom and pop shop thing, actually became a viable investment. So then Wall Street did what Wall Street does. They figure out how to monetize it, and they did what they do best. They pumped money into it, right? So an entire massive section of the bond side of the markets, the corporate bond side of the market specifically, became a player in this arena. Billions, and those billions in essence trickle down to Main Street. So what you're seeing right now is you're seeing a massive transfer of wealth where Wall Street is putting money behind these loans, these assets, and in turn securitizing these things and making even more money by selling them off, while creating or enabling for the creation of landlords. And what's amazing is, look, the standards are a little bit less than a bank, right? I mean, I myself, we own rentals, and we came up by frankly getting everything financed on that end by credit unions, and that was sort of like, the best we could do. And this, call it a movement, this is the worst thing that happened to credit unions, from that end, from the residential long-term rental end. This product is better in the sense that it's the pricing is pretty much the same. Frankly, at this point, we're at the same place. I'm, the best I ever got from a credit union was about 5.5. The best rate I ever put out on Arkad Capital side was 4.25. So the terms, frankly, better. I've never had a 30-year fixed loan. I've always had, and look, my partner's credit is impeccable. Our background is great. Our experience is phenomenal. We've never had anything more than a 25-year loan amortization with a year term. So I'm good for 10 years. I'll pay it off in 25 years, but I don't know what the hell is going to happen after 10 years. So, and that was the best that an LLC owned property would have. So the product that we have, first of all, we stretched it to 30 years. So we don't have 25 years. We stretched it 5 more years. What that did is it increased your cash flows on a monthly basis. We stripped a lot of the red tape, right? We got rid of all the requirements, the extra explanations, the where's this money coming from, the how much are you paying for the whole weight light thing, like all that is out. We care about the basics. We care about taxes, we care about insurance, we care about flood insurance and any of that, HOAs, and income, right? We care about what the property is grossing on a monthly basis. So what all this did was it allowed us to put forth a product that really caters to I mean, for all intents and purposes, landlords of all sizes, but it really has an emphasis on that entry-level landlord. That person that may not have it all figured out, but they have enough cash flow coming out to be okay. So a lot of that is happening right now, man. And of course, we have some amazing products on that end. We can finance you. Let's say you just find a rental, right? Like there's tenants in there, it's already sort of moving. We can finance that with 20% down, whereas most banks will need 25% down. So with us, 20% down, you can buy the rental. If you already own a property, or let's say you did a flip and you're like, okay, well, maybe I can get a lot of rent for this flip. Maybe I'm not going to sell it. Maybe I want to hold it. Maybe I want to live in it, right? Like, so, well, later on, but maybe I want to hold on to this thing for my portfolio. We can refinance you. Right. And a lot of what we're doing right now is cash out refinances. So not only that we're refinancing you on a 30-year fix at like a 5%, but you're coming out with a check. You're literally walking from the closing table with I mean, like we're doing one right now. This guy's walking out of the table with $285,000 from 5 properties he bought a year ago. It's surreal.
I don't want to interrupt you, Mario, but that's perfect. We had a question that came in before from Ashley saying, can you walk through a cash out refinance if you offer that?
Yeah. So pretty popular product right now, and you're seeing the feasibility of it happening because, as we all know, prices went up, and that extra equity was created. And a cash out refi, just like a refinance, but a cash out refi is very heavy on that extra equity. So whereas in a normal market, most people can usually just refinance whatever debt they have, because generally speaking, they borrowed at 65%, they're refinancing at 75%. That 10% went into closing costs and expenses and so on. So it's usually a cash neutral transaction. You get to keep the house, but you're not really walking away with any money. What's happening right now is because the markets are hot, equity has been created. So a lot of people, including the example I gave before, a lot of our borrowers that bought multiple houses, they said, well, you know what, these 2 that I was going to sell and make like $20,000-$30,000 profits, since the value went up, let me try to refinance it. So and hold it and keep it as a rental. So they get a tenant, or they put a sign, they see how much they can get. And generally speaking, that number is pretty high. Again, because of the same problem, right? Demand's high, not enough housing. So rental income is coming in higher. And that allows for a really nice cushy place for them to be in, because all of a sudden the value of the house is higher, the income of the house is higher. So yeah, all of a sudden they're in a position they can cash out, refinance, generally up to 75% of whatever the as is value of the property is. Your credit score has to be 680 plus. Um, and yeah, and you know, the process is really one of the same. I mean, it's pretty standard. 75% rates usually vary between like 5 and 6, somewhere in between. And the requirements are very light. I mean, we don't require experience for rental properties. We base it heavily on your credit and on the cash flows of the property. These are really cash flow loans. This is truly what they are. So as long as you have a good product that rents for a reasonable amount, or better yet, right above reasonable, then you're going to be in a good place. And you can, easy math, as is value times 75%. That's the max you're going to get. Take the debt, whatever loan you have on it. If you owe anything on it, reduce it from that, and that'll be your cash out. If you have no debt, if you own the property free and clear, then even better. Your closing costs are generally rolled in into the deal, so you don't need to bring money to closing. You don't need to pay for closing costs. It's usually just taken out from the proceeds from whatever money you're going to get.
Is there anything that Ashley could do? So, for example, is it just providing good books to you and then saying, "Hey, here's some comps," or anything that they could provide on their end to help facilitate a smooth cash out refinance transaction?
Yeah. So there are a couple of documents. I mean, we're quote unquote no doc, but no doc in the sense that we don't care about tax returns. We don't care about your paid stubs. We don't care about your personal bank account deposits and so on and so forth. We care about your credit. We care about your property. So now let's say, and this is applicable for cash out refis on purchases. On purchases, you may not know what the full story is, but on a cash out refi, we want to know what's been going on for the past 3 months, right? We want to see deposits. We want to know that this has been going on. Now, if you haven't rented it for more than 3 months, we want to know that at the very least you have a lease. So, needless to say, always get a lease signed. And secondly, that you collected a deposit. The tenant might not have moved in yet. They might be moving in at the end of the month. The lease might be expiring in the other place by the end of the month, and then they're going to move to your place. I mean, whatever the case may be, you need to have a signed lease with a collected deposit put into your bank account, because we're going to ask you for that. We're going to want to see the deposit from your tenant. We want to know that it's a real tenant, that this is really happening, as we're making a big portion of our decision on that income, on that tenant being in place. So the tenant part is quite important. We don't have seasoning on that sense. Like if you literally sign a lease today and you call me and say, "Hey, Mary, I got a tenant. It's 2,000. It's 200 more than what I thought I would get. Let's refinance this thing." We'll be done in about 2 weeks. And if the tenant hasn't moved in 2 weeks yet, it's okay, as long as we have that lease and we have that deposit. So that's important. If you've owned the property for longer, right? Like we're getting a lot of people that have bought a year ago. These properties have been ongoingly cash flowing for the last 6 to 12 months. If that's your case, then we just want to know what's going on. So what we're going to ask you for at that point is usually 3 months of bank statements, just showing the flow of the money, and that's it.
Awesome. So there you go. You got to get signed lease. You got a deposit and a record of payments being made. And if you have shoddy credit, get working on that now. So all right, we got one more question, and we can wrap up. And for you guys, we'll get some links for you so you can look at the programs in more detail. So our last question is by Deidre, and she says, when you say get approval, it's generic, correct? Not on a specific house?
Correct. So what we do, again, this comes from us being investors and asking our hard money lender for this, and our lender going, "What the hell are you talking about?" So one of the things that we realized is that not only that we wanted to approve people for specific deals if they had one, but we wanted to, and I can coin this term, blanket approve people for deals they don't have yet. Right. So when you go through our application process, this whole turnaround is in 1 day. So you apply today, by tomorrow you'll have all this. Part of our welcome approval package has, if you have a deal, it has a POF, an approval specifically for that deal with that property address, plus a second approval, which we call a blanket approval, that has no address, is yet to be determined. And generally speaking, right now we're actually approving, depending on your credit. It's going to be for $350,000 or $500,000. So that's your blanket approval for you to use on any other coming deal, any offer you want to make. Send it to realtors out there and so on. If let's say from the beginning you never had a deal, you just want to get approved, then the second portion applies. We send you the blanket approval for whichever amount you want us to send them to you to. Usually, again, 350 is usually the amount if you're just starting up. And that should be sufficient for you to proof up on making offers. And it's 100% verifiable. In fact, my name is on those approvals with my personal cell phone. So if and it happens, I don't know, 5 to 10 times a week, I get calls from realtors, wholesalers asking me if the borrower is qualified, if we, if they're able to close on the loan. Ironically, about half the time we already know each other. Like I bought a house from them in the past, or something. So there's always like, "Hey man, I didn't know you were lending now. Holy crap!" So, but point of the matter is, those approvals are verified by us personally. So, and this is when a realtor or a wholesaler is about to take on your offer or whatnot. So that goes out, and those get automatically updated pretty much every 2 to 3 months, depending on what you need. But the way we really try to play it, and look, that POF works very well. But we also help you negotiate. Like, let's say you're looking at a house and it's obviously not 500,000, it's 100,000, right? And the reno is 50,000. We can send you a POF specifically catered to your offer. So let's say you don't want to pay 100,000, you want to pay 80,000. We're gonna send you a POF that says that you're qualified up to 80,000. So we do a whole lot of that because I mean we know you're qualified for far more, but we help you negotiate as you put in offers and take advantage of the whole POF game. So I hope that answered that question.
Yeah, I think you covered a lot and beyond. So I think that wraps it up. Last call for alcohol. Get him in quick. No, I appreciate it, Mario. It's been good. It's always a pleasure to have you on. You guys, as you could tell, he's not just a lending business. You obviously get the experience through plenty of rehabs and attic levels and new construction that he's done. So definitely a resource to tap into. Like I said, we'll get the links up for you guys at the completion of the call, so you can go ahead and get more info on those programs. And we'll see you on the next one. So anything else you want to leave off with, Mario?
No, man, just thank you for the opportunity. It's a good time to be in this. I'm glad to see you're still kicking and screaming, man.
Yeah.
Yeah, like every other business, man, there's always a flow of new faces, but some of the old faces also fade away, right? So it's this everlasting circle. And the longer I'm in this, the more profound this gets to me to when it comes to people like yourself, man. I mean, it's faces that I saw 10 years ago, right? It's people and personalities that I got to share experiences with a while ago. And now the benefit of this is that these things are now memorialized for eternity, right? So so just that, man. It's a good time to be in this. I'm glad to see that you're still in this. I'm glad to see where we're still doing stuff like this, and yeah, man. Let the good times roll.
That's it, man. Always growing, forever student. Stay humble and just plugging away every day.
Yeah, man. Awesome. Thank you for the opportunity, bro.
Appreciate it. Thank you, guys. Appreciate you joining us, and I'll keep you. Well, hopefully you found a lot of insight and good content, and we'll keep you posted.
Awesome, guys.